the final example we're going to talk about covers accounts payable. Okay, so we've done 2 examples so far. One that looks at inventory and cash management. The other one that looked at receivables and short-term financial planning. And now we're going to be talking about accounts payable. And again, we're going to use a real-world example from Power Solutions International, which is the company we're looking at here. Okay. As a way of motivation and to introduce the topic we're going to talk about, I have here the liquidity ratios for PSI, okay? And you might recognize these liquidity ratios from Module 1. Those are exactly the ratios that we talked about when we were trying to measure a company's liquidity: the current ratio, the quick ratio, and the cash ratio. Here I'm doing the calculations myself. You should be experts at calculating these ratios already, right? So it's a good time. If you forgot the liquidity ratios, this is a good time to do a recap, right? And go back to Module 1 and then remember how to calculate these ratios and what do they mean, okay? So first question, is the current ratio a good measure of liquidity for a company like PSI? This is a topic that we covered in Module 1, right? So think about that, and you pretty soon should figure out that there is a problem with using just the current ratio as a measure of liquidity for PSI, given that the company has very large inventory, right? And this inventory is required for the business, so we should not think of this inventory as a particularly liquid asset, okay? So it's not a bad thing that they have a high current ratio, but it doesn't mean that that they can always rely on their inventory to manage liquidity, okay? So and if you look at the data in that slide, you'll see that PSI has very low cash, okay? The cash ratio is quite low, right? And is that a problem for the company or not? Okay, so let's think about that, right? The first observation, something we just covered in the previous example, or in the inventory example actually, is that PSI's operating cash flow is negative, okay? So you can check slide 90, for example, and you'll see that PSI has negative operating cash flow, right? And remember, the liquidity ratios, what they try to get at is whether the company has the ability to repay its current liabilities if they come due, okay? Since PSI's operating cash flow is negative, they definitely cannot rely on their cash flow to repay the current liabilities, okay? So how are they going to do it? When the current liabilities come due, how is PSI going to repay those current liabilities? Okay, so let's think about that. First data point that is very important for us to look at is to get some data on what exactly are these current liabilities. Okay, so let's open up the black box a little bit. Instead of just talking about total current liabilities, let's look at exactly which liabilities do they have. Okay, so here are some data for September 2014 for PSI. Okay, and what you see here in the data is that they have about $60 million in current liabilities. Okay, most of those are accounts payable. Okay, $46 million in accounts payable. There are some other current liabilities, a little bit of long-term debt that is coming due. Okay, 1.7 million of short-term debt that has to be repaid next year. Okay, and some accrued expenses. But most of the current liabilities is accounts payable, okay? So those are bills, right? Essentially, those are bills that the company has to pay to suppliers in the next year, in the short term, okay? So question is, for you, what will happen, okay? When PSI's accounts payable come due, what is the company going to do, right? Remember, they don't have cash, they don't have cash flow. Okay, so how are they going to repay these accounts payable? The answer is that PSI, as many other companies in a similar situation, is going to be relying on refinancing. Okay? The key idea here is refinancing. Okay? So what do we mean by refinancing, right? So they have 46.4 million in accounts payable coming due. Okay? They have to repay that. Let's say that comes due in 6 months. Okay? On average, on 6 months. When that liability comes due, what PSI is probably trying to do is to generate a new liability. Okay? So you pay the existing one, and then you borrow more from your suppliers. You go to your suppliers and say, look, I want to keep paying my bills on term, so I'm not going to pay cash. You know, I still want to wait 6 months to pay my bills. Let's just keep doing the business the way we've been doing business. What that means is that there is going to be no cash outflow to worry about, right? Think about this. You pay the liability, but at the same time you're borrowing money from your suppliers because you're generating a new liability for the future, okay? So there is no, there really isn't any cash outflow that PSI has to worry about, okay? Unless what? Unless suppliers deny to extend financing, right? This is the liquidity risk idea that we're going to talk about in this example. The liquidity risk that PSI faces is that suppliers may demand the payment of the 46 million and then deny the new financing, right? In that case, PSI may indeed face a liquidity crisis, right? Because they have to repay that liability, and they really cannot raise the financing from the suppliers anymore. So they cannot refinance, okay? When could this happen, right? One situation is an overall financial crisis, right? There might be an economy-wide financial crisis where all companies want cash immediately, they want to retain cash, so the suppliers may deny additional financing to PSI, okay? The other possibility is when the financial health of PSI deteriorates. Maybe their sales are going to grow less than expected, right? Or perhaps their costs are going to go up, their inventory is going to go up, okay? So if the financial health of PSI deteriorates, then they might have to refinance. The suppliers may actually deny the financing. The third one is that the financial health of the suppliers may deteriorate. Okay, so the suppliers might have been financially healthy, but they might run into problems and then try to raise some cash from their business with PSI. The bottom line is that there are many things that could happen that might create liquidity risk for a company in this situation, okay? So how would PSI manage this liquidity risk? They don't have cash, that's not what they do, right? They are not holding a lot of cash. So what are they doing? One possibility is that they are counting on their receivables, okay? As we discussed in Module 1, the quick ratio captures liquidity that comes from receivables, and if you look at the data, okay, they have $68.9 million in accounts receivable. Their quick ratio is definitely above 1, okay? So perhaps what they are doing is they are relying on their receivables to pay for the accounts payable if they come due, right? How can they do that? This is again a topic we covered already in this module, right? They could try to factor the receivables, okay? Instead of waiting to get paid in the future, they can go to a bank and raise money backed by the receivables. They can sell the receivables to a factoring company. They might get less than the full amount, but they will definitely get cash today that may allow the company to survive and pay accounts payable. Okay, so that is one possibility. It's essentially what they are doing is raising a short-term loan using receivables as collateral. Okay. The other possibility, which is a new idea I want to talk about now, is to manage liquidity risk using a bank credit line. Okay? First observation here is that PSI does have plenty of collateral, right? The inventory that they carry is not a very liquid asset, but it's definitely something that they can use as collateral to raise a bank loan, right? So if they don't repay the loan, the bank can repossess, the bank can take away the collateral and keep the collateral, okay? Same thing with receivables as we just talked about. The nice thing about credit lines is that credit line terms are negotiated ahead of time, okay? So PSI would definitely not wait until you are in a liquidity crisis, right? If to initiate a credit line, that would be the wrong thing to do. Would be probably much better to initiate a credit line today and have that deal in place so you can raise financing when the time comes, okay? To understand that better, let's talk a little bit more about credit lines. How do bank credit lines work, okay? A credit line, you can think of it almost like a credit card, okay? What the company would have a credit limit, okay? So there is a maximum amount that you can borrow from the bank, and the interest rate that is negotiated ahead of time, okay? So a company if a company has a credit line with a bank, you typically have a maximum amount that you can borrow at a certain interest rate, which is negotiated ahead. So it's typically a spread over LIBOR, right? So if the economy-wide interest rate changes, then the interest rate on your credit line would change, but the spread would not change. So the bank doesn't have the ability to, shoot the interest rate up to the roof if the company hits a liquidity crisis, for example. In exchange, what PSI does is to pay a commitment fee to the bank, okay? So if you have a $100 million credit line, for example, PSI would pay an annual fee, which for a company like PSI is going to be fairly low, typically 0.1 to 0.3% a year. They would pay a commitment fee to the bank to keep that credit line open. If you think about that, a credit line is very much like insurance, right? You're paying a fee, right, to the bank. If your house burns down, you have the right to draw on the credit line to meet a liquidity need, okay? And it turns out that for a company, for PSI specifically, it seems to be exactly what they are doing. Here's some data, okay, that I pulled out from PSI's financial statements. You can check that they actually do have a credit line. So let me explain these fields to you. You might not have seen this before. So the undrawn revolving credit is the credit line that the company has not drawn yet, that you haven't used, okay? So you can see that they have $48 million in that credit line. That means they can use that, they can draw, they can use this 48 million pretty much like a credit card, okay? If they do use it, it goes to this first item here, which is total revolving credit, okay? Total revolving credit means that this is a bank loan that was raised from a credit line. So you can see that they do have a large credit line as well, and maybe the size is not a coincidence, right? The size is pretty similar to the amount of accounts payable that the company has, okay? So the bottom line is that if a PSI hits a liquidity problem, if the suppliers don't want to extend financing, then they might be able to rely on their credit line, okay? They have the right to use that line just like a credit card, and it actually turns out that this is what they seem to be doing in practice to help manage liquidity risk.